Everyone's screaming.
Crypto is the future.
Meanwhile, others are shouting.
Stocks have proven themselves for 100 years.
But what if both sides are wrong, or at least not as right as they think? Because this debate, crypto versus stocks, has become less about strategy and more about team jerseys. People aren't investing anymore, they're rooting, like it's a sport. So in this video, I'm cutting through the noise. We'll talk about where crypto might go, where stocks still lead, and how to position your money for the next decade. And by the way, stick around till the end. I'll share one bonus strategy that almost nobody uses, but it's one of the few that's worked consistently across both markets and across decades. You won't want to miss that. Let's start with the reality check. Crypto and stocks don't just behave differently, they feel different. Crypto feels like adrenaline. Stocks feel like structure. With crypto, you can wake up one morning up 25% and the next morning down 40%. It's like riding a roller coaster blindfolded, thrilling if you're into that, terrifying if you're not. Stocks, meanwhile, move like a cruise ship, slower, heavier, but way more predictable. And yet, here's the twist. Both have made people rich, but also both have crushed people who didn't understand what they were holding. Let's go back in time. Between 2010 and 2020, Bitcoin returned over 9,000%. But to earn that, you had to sit through multiple crashes of 50% or more. Could you do that without panic selling? At the same time, the S&P 500 returned around 250%. Not as flashy, but it did so while allowing people to sleep at night. So the real question isn't which one moves faster, it's what are you actually built to handle? Because investing isn't just about choosing the most profitable asset, it's about choosing the one you won't abandon during chaos. Now, no one, including me, has a crystal ball, but we can look at history, patterns, and what's actually happening in both spaces. Let's talk crypto first. Crypto is evolving fast. It's not just Bitcoin anymore. Ethereum is powering smart contracts. Layer 2s are making things faster. Stablecoins are disrupting payments in ways banks can't match. There's also real infrastructure being built, tokenized assets, decentralized identity, and even real estate moving onto blockchain rails. This isn't hype, it's slow, quiet progress. But progress doesn't guarantee price growth. Crypto remains volatile, unregulated in many ways, and still subject to narrative shifts, hacks, and policy risk. Now let's contrast that with stocks. Stocks aren't standing still either. Companies like Nvidia are blurring the line between traditional finance and frontier innovation. Tesla isn't just a car company, it's an energy and AI firm disguised as a car maker. Even big tech names like Microsoft and Apple are investing in decentralized infrastructure behind the scenes. What this means is, the crypto versus stocks debate might become irrelevant. Because over the next decade, the line between these two will blur. Blockchain will live inside many public companies. Meanwhile, crypto assets will look more and more like equity-like systems. So instead of asking, which is better? The smarter question is, what role does each play in my wealth strategy? Crypto is high upside, high risk, your venture bet. Stocks are compounding machines, your core wealth builder. The investor who holds both? That's the investor who plays to win in more than one direction. Let's address the traps most people fall into. Going all in on crypto. This is usually fueled by greed, FOMO, or some influencer flashing a screenshot of their latest altcoin win. People think they've found the shortcut, but history says otherwise. Any portfolio that only works if everything goes right is a trap, especially when it's built on assets that can lose 70% in months. Avoiding crypto altogether. This one usually comes from fear, or someone clinging too hard to the phrase, if it ain't broke, don't fix it. But ignoring innovation isn't risk-free. It's just a slower, quieter kind of risk. Falling behind. It's like in 2005, people who said the internet was just a fad, while Amazon quietly built the infrastructure of the future. The lesson? Exposure doesn't have to be extreme. You don't need to go 50% into Ethereum, but 5%? That's enough to benefit if crypto plays out, and small enough to sleep at night if it doesn't. Smart investors don't bet on trends, they allocate for scenarios. Now, as promised, here's a bonus concept that ties this all together. The smartest portfolios are built around optionality. That means creating space to benefit from multiple futures, not just betting on one. Own index funds like VTI or VOO. That's your base. Add SCHD if you love dividends. Hold QQQ or QQM for growth. and then allocate a slice to crypto, whether it's BTC, Ethereum, or a carefully chosen project with real-world traction. And here's the trick. Don't guess the future. Build a plan that benefits from whichever future wins. This is how real wealth is built, quietly, intentionally, across cycles. If this gave you clarity, or even just made you rethink your approach, hit that like button. It helps more than you think. Comment below. Are you leaning more toward crypto, stocks, or both? And if you want weekly financial content that actually helps you make decisions, subscribe to Spendium.